Okay, let's unpack this. For years, the conversation around institutional crypto adoption, it really focused on the big names, didn't it? Bitcoin, structured ether products, maybe, regulated custody.
Absolutely. Predictable assets, relatively speaking.
Yeah.
Stuff that fits more easily into traditional finance boxes.
But what happens when a publicly traded company, and I mean one that used to sell literal treadmills and weight racks, decides to pivot its entire corporate identity and invest millions directly into the infrastructure underlying, well, meme coins?
Yeah, it's not just a pivot, is it? It's more like a tectonic shift. It changes how traditional finance is looking at arguably the most speculative, culturally driven corner of the whole digital economy.
Exactly.
We were looking at a serious, I think, structural signal here, that the definition of what counts as a valuable crypto asset,
Yeah.
well, it's expanding. It's going beyond the blue chip layer ones,
Right into the plumbing almost.
deep into the digital plumbing, specifically of the Solana ecosystem. Highly specialized stuff.
So our mission today, it isn't just to report the news. We need to critically analyze what this Australian corporation has done. It's audacious.
Really is.
We need to figure out the technical side, the financial implications, the narrative shifts. What does this massive targeted buy mean for the whole concept of meme infrastructure? And frankly, for institutional risk-taking. Can this possibly be justified, under the traditional lens of, say, fiduciary duty?
That is the essential question, isn't it? And it leads straight to the wow moment, the thing that really defines this whole deep dive.
Okay, lay it on us.
Australia's Fattel Corporation. Used to be a pretty mundane, fitness and gym equipment retailer. They just announced they've acquired a staggering 216.8 million PUMP tokens.
216 million.
0.8 million, yeah.
Yeah.
PUMP is the core asset of a meme coin launch platform, and they paid about $1.5 million for it. And look, this isn't some passive investment. It's not like just holding some stock. This feels like an activist stake, an infrastructural stake in what's become a rapidly evolving cultural engine on Solana.
A fitness retailer buying 216 million tokens for a meme coin launchpad.
Okay, yeah.
So
That sentence alone demands a full deep dive. Let's start by establishing just how big this change is. Okay, let's delve into Fattel Corporation then. Think about their original business, right? Selling gym equipment across Australia. Probably low margin, lots of logistics, physical retail, distribution.
Very traditional, predictable cash flow, hard assets on the balance sheet, warehouses, inventory.
Exactly. Now, they are attempting one of the most dramatic corporate transitions I think we've ever seen in the public markets. What is the actual scope of this shift? How deep does it go?
Oh, it's a complete corporate metamorphosis, really. They're shedding that old identity entirely.
So it's not just adding a crypto arm?
No, they're actually rebranding. They're becoming the Solana Australia Corporation.
The Solana Australia Corporation, okay. And the goal is explicitly stated. They want to become the primary public vehicle, in Australia at least, providing direct, maybe even leveraged exposure to the Solana ecosystem.
So this goes way beyond just, sticking a bit of SOL in their treasury like some companies have done with Bitcoin.
Miles beyond. This is about deep integration, operational, financial, the whole shebang.
I have to inject some skepticism here, though. They have a fiduciary responsibility to shareholders. How does the board of a company that used to focus on weight racks justify pivoting their entire business model, betting the farm on the infrastructure of a hyper-volatile digital asset class? It sounds less like a strategic pivot, maybe, and more like, I don't know, sophisticated corporate speculation, just wrapped in a new ticker symbol.
And that's the critical challenge, isn't it, for their investors, for the market. It really highlights just how extreme this decision is. Their justification seems to rest on two pillars: perceived market opportunity, obviously, and crucially, strategic capital.
Okay, let's talk about the capital then. How are they funding this? Pivoting isn't cheap.
No, and the scale of their commitment here is, well, staggering. Fattel has secured a substantial $100 million credit facility.
Wait, $100 million? For a fitness retailer pivoting to crypto, that's extraordinary. Who's providing that kind of money? And what's the likely structure? Is it traditional bank debt or something more? Crypto native?
Yeah, it's a huge sum. And this is where we see traditional finance, or at least parts of it, starting to catch up to these digital asset ambitions.
Ah.
The specific counterparties aren't fully public, but you're right. Facilities this large are rarely unsecured.
Right.
This funding is specifically earmarked to build and fund their new Solana Treasury. The probable structure could involve a few mechanisms. Maybe it's secured, non-recourse debt backed by Fatel's existing traditional assets.
Ah, so leverage the old business.
Exactly. Use the inventory, the real estate, the legacy cash flows, the stable stuff as collateral to buy the volatile stuff. Use the old world stability to fund the new world speculation.
Makes sense. Risky, but makes sense.
Precisely. Or, alternatively, we could be looking at structured lending. Maybe capital providers willing to take a higher interest rate, potentially secured partly by the SOL they acquire. Asset-backed lending against the digital treasury itself.
Yeah.
That's pretty common with specialized DeFi lenders.
Interesting.
But regardless of the exact structure, the fact that $100 million in institutional debt is available just to fund a Solana-centric treasury that confirms the risk appetite among certain funds, certain specialized crypto lenders, has drastically increased.
Yeah.
This isn't just hobby money anymore. This is the financial foundation for a public company's entire new strategy.
Securing $100 million to build a treasury focused on one specific blockchain. I mean, that immediately puts it in the same league, maybe even more extreme as those earlier corporate pivots we saw, right? The ones focused on Bitcoin infrastructure.
It's the closest historical precedent, definitely. Think about companies like Marathon Digital or Core Scientific. They pivoted their whole operational model around Bitcoin mining.
Right, they bought hardware. Yeah.
Exactly. They acquired tangible physical infrastructure. ASIC miners, real estate, big energy contracts. Fatel is doing something similar, but instead of physical hardware, they're acquiring foundational digital assets. Assets tied to the cultural, the economic throughput of Solana.
So their infrastructure isn't steel and silicon.
No, it's software and token economics. It's code and community.
But those previous pivots, they involved Bitcoin, right?
Right.
Which, while volatile, is arguably a more established, maybe predictable commodity compared to, well, the underlying assets of a meme coin factory. That shift in the type of asset is just profound.
It is.
It suggests they aren't just buying SOL, the base layer token. They're buying the digital plumbing needed for the culture, the transaction volume on Solana to sustain itself.
And that's the crucial distinction, I think. They're aiming for leverage on the activity happening on the chain, not just betting on SOL going up. The traditional mining pivot gave exposure to hash rate, that sort of industrial output.
Yeah.
The Fatil pivot. It seems to be aiming for exposure to cultural virality. Much harder to quantify, much more volatile.
Which brings us squarely to the specific asset they bought, PUMP. We need to go beyond just calling it the meme coin factory. For listeners trying to understand the infrastructure claim here, what does PUMP.fund actually do, technically? What innovation does it bring to Solana that could possibly justify an institutional treasury allocation?
Okay, yeah, good question. PUMP is the native token of the platform pump.fund. And to get why it's significant, you need to understand the problem it solved in the, let's be honest, often chaotic world of meme coin launches.
Which is mainly
the notorious rug pull, right? And also just the difficulty of setting up fair initial liquidity for a brand new token. Pump.fund is a really elegant Solana-based solution that has, frankly, revolutionized how these tokens get launched.
Okay, so explain the core mechanics then. How does it actually work, and what makes it better infrastructure than, say, just launching a token on a regular decentralized exchange like Radium or some generic launchpad?
The absolute key innovation is its use of something called a bonding curve. Traditionally, if you wanted to launch a new token, the creator had to manually set up a liquidity pool on a DX.
Right.
They'd have to deposit their own capital, usually SOL paired with their new token, to provide that initial liquidity. But this creates two huge risks immediately.
Okay.
One, if the creator just pulls that initial liquidity out, that's the classic rug pull, the token instantly becomes worthless. Poof, gone.
Yeah, we've seen that too many times.
And two, the initial price discovery is completely manual, often really volatile, easy to manipulate.
Okay, so the bonding curve fixes this. How?
It pretty much eradicates these main risks, which is exactly why it's seen as a legitimate infrastructural improvement. When a new token launches on pump.fund, it doesn't start with a traditional liquidity pool on a DX.
Okay.
Instead, the price is determined automatically by this bonding curve model.
Yeah.
As more people buy the token using SOL, the price algorithmically and steadily increases along this predefined curve.
So the price movement is predictable, based purely on demand on how much SOL goes in. And crucially, the liquidity.
The liquidity is guaranteed. All the SOL that early buyers spend goes directly into this bonding curves pool. Then, once the token's market cap hits a specific threshold, it's often around $69,000, kind of a meme number itself.
Right.
The platform automatically takes that accumulated SOL liquidity plus a portion of the token supply and migrates it to create a permanent liquidity pool on a major Solana DX like Radium. And here's the killer feature. That initial DAX liquidity is burned or locked forever.
Okay. That's the critical technical detail. By locking the liquidity automatically, Pump.Fund guarantees there's always some baseline value, a permanent price floor you can sell into. It makes it immune to that founder-driven rug pull.
Exactly. That fundamental safety mechanism drastically cuts down the structural risk for retail participants. And maybe more importantly for this conversation, for potential institutional buyers who are obviously concerned about market integrity and scams.
It basically transforms the launch mechanism from something speculative, opaque, and risky into a standardized, trustless, and super efficient factory floor for churning out new assets.
That's a great way to put it, a factory floor. And because it's so easy and relatively safe to use, it drives massive transaction volume on Solana. Which brings us back to Fattel's stated rationale for buying PUMP.
Right. They said it wasn't purely speculative.
No. Their argument is that this buy isn't just a bet on the PUMP price going up. It's a bet on the sustained success of this whole launch model.
Okay, but if they were just speculating on meme coins, they could have bought Dog with Hat or Bonk or something, right? Why buy the infrastructure token, PUMP? What's the explicit technical case for PUMP tokens themselves holding value as a core asset? Does PMP actually accrue revenue from all this platform activity?
That is the million-dollar question, isn't it? Or, well, the $1.5 billion question for Fattel. They view PUMP as a core asset for, and this is their term, ecosystem alignment.
Ecosystem alignment, okay.
So the value of PUMP, beyond just market sentiment, must stem from some underlying utility or a claim on the platform's activity. Now, Pump.Fund's exact tokenomics can be dynamic, things change, but the justification for a big institutional allocation like this usually rests on one or maybe more mechanisms.
Such as?
Firstly, fee accrual. Does holding PUMP give you a stake in the platform's revenue stream? Pump.Fund must generate enormous fees, right? From all those token migrations, maybe small transaction taxes. If PUMP holders get a slice of that revenue.
How? Like through staking rewards?
Yeah, either directly through staking rewards, maybe distributed in SOL or USDC, or indirectly through the platform, using fees to buy back and burn PUMP tokens, which reduces supply and should increase value. That provides a tangible, fundamental valuation floor. It's the classic DeFi infrastructure playbook.
That would definitely justify calling it infrastructure. They're essentially buying a share of the toll road revenue.
Precisely. That's the cleanest argument. Secondly, there could be governance and utility. Maybe owning PUMP grants discounted access to platform services. Perhaps the Solana Australia Corporation plans to launch its own ecosystem tokens using Pump.Sun, and holding PUMP makes it cheaper or faster for them.
Interesting.
It could also give them governance rights, letting them vote on key platform upgrades, fee structures, maybe even the rules of the meme factory itself. Influence over the ecosystem.
So the big idea is it's not just a short-term trade for profit. It's about embedding themselves deeper in the ecosystem, gaining that alignment, that infrastructure exposure.
That seems to be the narrative. They're betting on the Pump.Fund model sticking around and growing because they now own a piece of the actual rails, the machinery that facilitates a huge chunk of Solana's viral growth and retail activity.
And framing it that way lets them categorize the investment differently, right? Not just buying a volatile token, but acquiring a strategic stake in a critical utility layer. Almost like buying shares in a really profitable stock exchange, but decentralized.
Exactly. That's the sophisticated institutional argument they'd likely make for owning meme infrastructure. It's a bold claim, but you can see the logic. And this leads us directly to maybe the most powerful element of this whole thing, beyond the financials. It's the signaling effect.
Right.
When a publicly listed company, even one doing a massive pivot, sure allocates significant treasury cash to buy the native token of a meme factory. Well, that's an unprecedented endorsement.
Yeah, the immediate institutional backing, just the fact that it happened, gives the PUMP token and maybe the whole Pump Fund ecosystem a vastly higher perceived legitimacy, doesn't it?
Totally transformative. Before this, Pump Fund was seen as, innovative, definitely grassroots, maybe a bit Wild West, but ultimately a very volatile hub for degen activity. It has corporate validation from an entity that has to do public reporting, audits, answer to shareholders, that changes the perception overnight.
And what does that do for other institutions, the ones maybe still sitting on the sidelines just holding SOL or ETH?
It forces a recalibration, I think. They have to look at this and reconsider. Maybe meme coins aren't just these weird novelty assets anymore. Maybe they're actually crucial high-velocity mechanisms that drive the underlying chain's volume, its user adoption, its stickiness. It suggests that institutional due diligence is now moving deeper into these really hyper-specific subsectors of crypto, not just the base layers.
So we could be witnessing a pretty massive narrative shift here. The idea that meme coins are only speculative, chaotic experiments, totally divorced from any real utility. That idea is being directly challenged by corporate action.
Yeah, they're starting to be potentially viewed, at least by some, as infrastructure or utility layers in their own right, layers necessary to fuel the growth story of certain chains, especially Solana.
And the data supports that, right? Pump fund drives a lot of activity.
A huge percentage of daily new token launches on Solana happen there. And all the associated transaction volume, the DEX activity that follows, it's massive.
Yeah.
So if you want exposure to Solana's defining characteristic, that really vibrant, low-fee, retail-driven activity, you arguably have to engage with this layer somehow.
Let's quickly analyze the immediate market implications. A buy this size, 216 million tokens for $1.5 million. It suggests they got in relatively early or maybe through an over-the-counter OTC deal. Either way, that's a significant demand shock, right?
Exactly right. A huge allocation like that immediately just soaks up sell-side liquidity. If that purchase happened quickly on the open market, boom, immediate, sustained upward price pressure just from this supply shock alone.
And even if it was OTC?
Even if it was an OTC deal, it means a giant new holder, presumably a long-term strategic one, just entered the picture. A massive tranche of tokens just moved out of the likely retail trading float and into a corporate treasury. That reduces the available supply for sale dramatically. Big impact either way.
Okay. And what about the potential ecosystem multiplier effect? If Vitel's big corporate commitment encourages more sophisticated users, maybe developers, maybe even other public companies to take Pump.Fund more seriously, could we see a kind of snowball effect?
That's the bull case, absolutely. More trust leads to more usage, which means more launches, which drives higher trading volume. And that benefits PUMP token holders potentially. It benefits the whole meme coin ecosystem on Solana, and ultimately it benefits the underlying Solana chain through transaction fees and activity. It's a potential positive feedback loop.
We should probably connect this to historical parallels, but maybe go beyond just MicroStrategy and Bitcoin. Think about the effect high-profile endorsements had on assets like, say, Dogecoin or SHIB back in the day.
Right, but those were often celebrity tweets or maybe high-net-worth individuals talking them up. This feels fundamentally different.
How so?
Vitel isn't just endorsing a meme. They seem to be acquiring the means of production for future memes. They bought the factory, not just the product.
Ah, good distinction.
That institutional stamp of approval, applied to the infrastructure level, is potentially the key ingredient. It could validate the asset class, or at least this part of it, providing a sort of cultural gateway for broader adoption of Solana's whole retail-focused engine. Now, what's really critical to understand here is that Vitel's move, as aggressive and, frankly, weird as it seems, it's not happening in a vacuum. It's not an isolated experiment.
Okay.
It's actually just the most extreme example we've seen so far of a much broader and seemingly accelerating institutional trend, a trend focused specifically on building Solana-centric treasuries.
So you're saying there's a distinct growing asset class emerging here, something we could call strategic Solana reserves, SSR.
Yeah. I think that's a perfectly valid way to frame it, yeah. And we have some hard data on the scale of this institutional commitment just to Solana's native asset, SOL itself.
Okay, give us the numbers. How big is this institutional wave?
The data we're seeing is pretty compelling. It points towards serious systemic integration. We're currently tracking approximately 18 known institutional entities. These are public companies, investment funds, asset managers that collectively hold an estimated 18 million SOL.
18 million SOL. Wow. What's that worth?
At current valuations, that works out to roughly $4 billion in institutional capital, just dedicated to the Solana ecosystem.
$4 billion. Okay, let's put that in perspective. What percentage of Solana's total supply is that?
It represents about 3.1% of Solana's circulating supply, held just by these tracked entities.
3.1%, that's actually quite significant, a concentrated holding like that. What are the implications? Not just for price, but maybe for things like governance or potential centralization down the line.
Yeah, that concentration is highly relevant.
Yeah.
It introduces at least two distinct implications. First, price stability, potentially.
Hmm.
Large, strategically held treasuries, they tend to behave differently than retail holders, right?
Less likely to panic sell.
Exactly. They're less likely to liquidate during short-term dips. They often have a mandate to hold long-term, so they can act as a kind of stabilizing floor under the asset price. Diamond hands by corporate policy, almost.
Okay. And the second implication.
Governance power. In a proof-of-stake system like Solana, owning SOL translates directly into validation power, into voting influence on the network's future. Holding 3.1% of the circulating supply gives these 18 or so entities pretty significant collective sway over decisions. Protocol upgrades, fee structures, maybe even the fundamental direction of the network.
So it's not just investment, it's potentially buying influence.
It signals a long-term strategic interest in influencing the network's evolution, absolutely. That concentration is definitely a key metric the wider community needs to keep watching, especially regarding potential governance centralization over time.
And this movement, this SSR trend, it's not just Fattel's dramatic pivot. Who are some of the other players involved? What kinds of companies are building these Solana reserves? Do they have similarly strange origin stories?
It's actually a pretty diverse group joining this wave. You have companies like Forward Industries. Historically, they were known for making specialized carrying cases, protective gear, that kind of thing. Now, they publicly list significant SOL holdings.
Okay.
Then there's Sharps Technology. Their core business is, or was, medical injection technologies, syringes, safety devices. They've also pivoted their treasury strategy towards digital assets, including Solana.
Wow. From medical tech to Solana.
Yeah. And then you have groups like DeFi Development Corps, which are being explicitly built from the ground up, specifically to utilize Solana's infrastructure. So the common thread seems to be that previously disparate industries, manufacturing, medical tech, logistics, are now identifying Solana as a core technology platform to potentially stake their future growth on.
This sounds incredibly familiar. We have to draw the parallel again, the really crucial historical one, MicroStrategy and Bitcoin. This whole SSR wave feels like it echoes that earlier movement, but maybe with a distinct higher beta flavor.
It is absolutely the most direct historical analogy. When MicroStrategy started making those large and, importantly, very vocal Bitcoin allocations,
They shouted it from the rooftops.
they really did. And it achieved two main things. First, it normalized the whole concept of Bitcoin as a viable corporate reserve asset, something that could compete with cash or low-yield bonds on the balance sheet.
Right.
And second, it acted as this colossal signal flare to other boards, other corporate treasurers around the world. It basically said, hey, this strategy isn't fringe anymore. It's a viable, potentially high-growth strategy.
MicroStrategy made it intellectually okay, maybe even fashionable, for C-suite executives to actually discuss Bitcoin strategy in a boardroom setting.
Exactly. And Fattel's move rebranding as Solana Australia Corporation, buying infrastructure tokens like PUMP, feels like it's attempting a very similar signaling play, but aimed specifically at the cultural and retail engine of Solana.
So if MicroStrategy legitimized Bitcoin as a corporate reserve,
Then the Fattel effect, if it works, could potentially legitimize Solana-based infrastructure assets, even the really speculative ones tied to meme coins, as viable corporate growth drivers. They're essentially saying, look, the value generated by digital culture, by memes, by online communities, it's real, it's measurable, and it's actually worthy of public treasury investment.
that is a significant leap, a huge leap forward in institutional risk tolerance, and maybe their understanding of crypto-native business models. Okay, but all this institutional enthusiasm, it needs to be tempered with some serious scrutiny, right? Given how volatile this whole sector is, we have to be absolutely clear-eyed about the risks. What's the immediate overriding financial danger in Fattel's high-stakes bet?
Well, the primary risk, as with any really concentrated bet, is simply concentration risk. $1.5 million might sound small compared to that $4 billion in total SSRs we mentioned, but for PMP specifically, that bet is highly concentrated relative to PMP's overall market structure, its liquidity profile.
Meaning, if PMP crashes,
If PUMP were to suffer a rapid, steep decline, which is entirely possible with these kinds of assets, the downside exposure for Fattel is disproportionately magnified, especially since their entire new corporate identity is now tied to the perceived success of Solana and its cultural engine. This investment amplifies both upside and downside risk massively.
okay, concentration risk. What else? Beyond just price volatility, what about the structural risks? They bought a huge chunk of tokens, 216.8 million PUMP, we need to know more than just if they're locked up. What are the implications of different lockup scenarios?
Yeah, this is absolutely fundamental for anyone analyzing the market impact. We have to consider two major structural scenarios, especially if the full details of the purchase regarding vesting aren't public yet.
Okay, scenario one.
Scenario one, fully
Ah.
unlocked and liquid. If those 216.8 million PUMP tokens are immediately liquid, tradable right now, that represents a massive potential overhang, a constant threat of future sell-side pressure hitting the market.
Have
Well, if Intel decided, for whatever reason, to liquidate or just diversify, even a small fraction, say, just 10% of their holding, that sudden inflow of tokens could potentially swamp the typical daily trading volume for PUMP. It could trigger a significant, maybe even sustained, price correction. For any short-term trader, that's a huge market saturation risk hanging out there.
Okay, that's the risky scenario for the market. What's the alternative? The one that might signal more long-term commitment from Fattel.
That would be scenario two, structured vesting or lockup. A more, let's say, responsible institutional approach would likely involve some kind of vesting schedule, maybe a one-year cliff where they can't sell anything, followed by linear vesting over, say, 3 or 4 years.
And that signals.
It signals a commitment to the platform's long-term growth. It also manages that supply-side inflation risk for the market. If the tokens are locked up, they're functionally removed from the circulating supply for the near term, which actually acts as a deflationary pressure. So understanding that lockup schedule is absolutely vital for forecasting future inflation risks and general market stability for PUMP.
We also can't ignore the narrative versus fundamentals risk, can we? Pump.fund's success really hinges on this rapid-fire meme coin culture continuing on Solana.
Absolutely. What happens if that enthusiasm just fades? Or if a competitor pops up? Maybe an even more efficient launchpad emerges, either on Solana or, a rival layer one.
Then Fattel could be left holding a core asset for a platform whose utility, whose volume has basically evaporated.
Exactly. Meme coin hype is notoriously fickle. If PUMP fails to keep innovating, if it doesn't deliver on that promise of fee accrual or real governance weight, then sentiment could reverse incredibly quickly. And suddenly the Solana Australia Corporation is holding an asset valued purely on past speculation, not current infrastructure value. Big problem.
And then finally, there's the elephant in the room we can't avoid, regulatory scrutiny. When a public company subject to normal audits, standard regulations, makes a massive buy of tokens tied explicitly to meme coins.
That's got to invite some unique challenges, right? Oh, absolutely. The risk of asset classification is very real here. Regulators, especially depending on the jurisdiction, might look at the PUMP token, particularly if it does provide fee accrual or governance rights tied to the efforts of the centralized entity running Pump.fund, and potentially classify it as an unregistered security.
And if that happens?
A regulatory challenge against PUMP itself, or even just against Fattel's classification of the asset on its balance sheet, could instantly trigger massive legal headaches, huge liabilities, and just general market uncertainty. The board has definitely taken on significant legal and regulatory risk by stepping into this very specific, very new subsector.
Okay, so knowing all these risks, let's try and define the potential scenarios that listeners should actually be watching for going forward. What does a win look like here? The green light scenario.
In the best case, the green light scenario. The PUMP allocation is a huge success. The token appreciates significantly, providing Fattel a massive ROI on that $1.5 million. But more importantly, it validates their whole model. It leads to a wave of other institutions maybe setting up their own meme coin infrastructure treasuries. Solana's meme economy gets even stronger, cementing its position as the go-to retail chain. That's the dream for them.
And the flip side, the pessimistic view, the pullback scenario.
That's where the PUMP price falters. Maybe due to competition, maybe just market fatigue with meme coins. The whole narrative that meme coins are a viable institutional growth driver collapses. Institutions that built up these SSRs, including Fattel, might feel pressured to retreat, maybe liquidate holdings at significant losses. That would really damage the reputation of this entire nascent trend.
And is there a middle ground, maybe selective expansion?
Yeah, that seems plausible too. Fattel might not just stop at PUMP. They've got that $100 million credit line, remember. They could use it to diversify. Buy other key SPL ecosystem tokens, maybe governance tokens for major Solana DeFi protocols, liquid staking derivatives, other infrastructure plays.
Or maybe even try to get yield from PUMP itself.
Exactly. They might even try to build yield strategies or structured products around that massive PUMP holding, trying to turn what looks like a purely speculative asset into something that actually generates ongoing revenue for the corporation. That would be a very sophisticated financial engineering play.
Okay, so if our listeners want to really track this, gauge the sustainability of Fattel's move and the broader SSR trend, what are the specific actionable metrics they should be watching right now?
We're getting practical.
We need deep analysis, first off, of the P/E trading metrics. And don't just look at the price, right?
No, definitely not just price.
Yeah.
Track the daily and weekly volume shifts. Are they increasing or decreasing? But maybe more importantly, track the flow of PUMP tokens onto and off centralized exchanges.
Why is that flow so important?
Because large deposits onto exchanges usually signal intent to sell. That's potential selling pressure building up. Conversely, if large amounts of PUMP are being consistently swept off exchanges into cold storage or known corporate custody wallets, that suggests accumulation. True institutional buying, maybe, rather than retail churning, that flow tells you a lot about market sentiment and positioning.
Good point. What else?
We also need to keep analyzing the concentration of holders. Fattel's initial purchase obviously concentrated ownership significantly. Analysts should monitor the whale wallets, those holding big chunks of PUMP. Is ownership staying stable among a few large holders? That implies stability. Or are those large wallets starting to fragment, sending tokens to exchanges? That implies distribution, potential volatility ahead.
Okay, flows and concentration. What about broader market context?
Look at the correlation heat map. How does PUMP's price move relative to other key assets?
Yeah.
Does it track SOL really tightly? If so, it might just be acting as a leveraged proxy for Solana sentiment, or does it decouple sometime?
And if it decouples?
Decoupling could suggest PUMP is moving more based on platform-specific news, like pump.fun feature updates, maybe Fattel-driven narrative specifically, or internal tokenomic shifts rather than just general market tides. Understanding its correlation helps understand its drivers.
And since Fattel is a public company,
We can track the traditional market's reaction. Use public market data check, Yahoo Finance, or similar monitor the stock price of Fattel, ticker FPEL. Look at its performance before and after the announcement. Did the stock price jump, suggesting the market liked the aggressive pivot? Or did it fall, suggesting traditional investors saw it as reckless? That stock reaction is a critical barometer for how the legacy financial world is processing this whole thing.
great point. One last thing for the really detailed analysis.
For the most sophisticated analysts, you absolutely must actively overlay any known or even rumored token unlock investing schedules onto the PMP price chart. If PMP is scheduled unlocks coming up maybe for early investors, founders, the team, those dates represent predictable future inflation events, potential supply dumps that could seriously dampen price action, regardless of how positive Fattel's signaling is. Ignoring vesting schedules in this part of the market is basically financial negligence. Hashtag tag outro.
Wow, okay. This has been a truly comprehensive dive, hasn't it, into this fascinating and, let's be honest, kind of absurd intersection of traditional corporate finance, legacy businesses selling treadmills, and the most aggressively speculative corner of the crypto market. Let's try and recap the critical takeaways for everyone listening.
Yeah, let's boil it down. First, I'd say risk sizing is still absolutely paramount. Just because an institution buys something doesn't magically eliminate the extreme volatility inherent in these assets,
Yeah.
especially meme coin infrastructure.
Right.
If you're thinking about positioning around assets like PUMP, highly speculative, narrative-driven, your exposure has to be modest, sized appropriately to handle potential 50%, 80%, even 90% drawdowns. Don't bet the farm.
Good advice. Second takeaway.
Second, while that narrative momentum can create these huge, fast opportunities, you always have to check the liquidity and the structural fundamentals before chasing the headline. Understand the techs, the bonding curve, the vesting schedule, the token's actual utility, if any. Don't just trade the news without doing the deep homework first.
Makes sense. Always do YOR, do your own research. And third,
Keep tracking the other public companies making these crypto treasury bets. This really does feel like it's establishing a new, distinct asset class. We might soon be talking routinely about Solana treasuries or strategic digital asset reserves. This trend seems to be only accelerating, and understanding the drivers behind these SSRs is going to be key to navigating the next market cycle, I think.
definitely something to watch. Okay, so we leave you today with this final thought to chew on. Do meme coins or the infrastructure around them, like PUMP, actually require utility in the traditional sense? Fee accrual, governance rights. Do they need that to sustain institutional interest in the long run?
Or is just being the most effective, the safest, the most trustless on-ramp, that cultural gateway we talked about, is that enough? Enough utility in itself to justify millions, maybe eventually billions, in corporate treasury allocations?
It really gets to the core of the legitimacy debate for this whole digital economy, doesn't it?
Can cultural relevance itself actually be quantified, owned, and leveraged as a real corporate asset?
Yeah.
That's the big question Fattel is forcing us all to ask.
That is definitely the question for you to mull over. And hey, speaking of value, if you found this breakdown useful, if you got something out of this deep dive, engaging with this content really helps us out enormously.
It really does.
Subscribing to the channel, dropping a comment, sharing this discussion, it all helps support us, boosts our visibility in the algorithms, and it lets us keep creating this kind of quality, high-signal content for you.
We appreciate it.
So drop your thoughts in the comments below. What do you think? Is this Fitel move a genuinely smart institutional bet on critical infrastructure? Or is it just a super high-risk meme grab kind of dressed up in a fancy corporate rebrand?
Let us know your take.
We'll highlight some of the top comments in the next episode. Thanks so much for tuning in. We'll see you next time.